Hello viewers, welcome to GalaxC Stock Bites. In this clip, we shall examine two approaches to investment. Number one is a top-down approach and the other is the bottom-up approach. What is the top-down approach? The top-down approach, as the name suggests, looking at the economy from the macroeconomic perspective. We look at numbers like GDP growth, we look at numbers like inflation data, we look at the monetary policy, we look at interest rates, and then we look at sectors which have significant tailwinds coming from these macroeconomic factors, and thereafter create a portfolio of companies from within these sectors. This is the top-down approach. The other approach is the bottom-up approach. Here we select companies based on company fundamentals. We look at factors like EPS, we look at factors like price to earnings multiples, we look at return on capital employed, and create a set of stocks in the portfolio which are delineated from the macroeconomic story. In which scenarios will these two sectors perform? The top-down approach tends to perform well in a cyclical scenario. When there are macroeconomic tailwinds and the macroeconomic situation is favorable, the top-down approach works. But when the macroeconomic scenario is a little uncertain, you have to be stock specific, and that's when we recommend switching to the bottom-up approach, where we look at companies for their own intrinsic value and we look at factors which are driven by company fundamentals rather than macroeconomic, and create a portfolio of stocks which are bottom-up in nature. At this point in time, we find the macroeconomic factors are a little tentative. There are global crises at play. There are uncertainties like the trade policy at play. So in situations like this, we would follow a bottom-up approach rather than a top-down approach.